Hi, welcome back to another practical video of A to Z accounting problem. Today we are going to discuss about the statement of cash flows uh, under indirect method. So here today we are going to discuss the calculation of statement of cash flows in a shortcut, very easy method. Yeah, in Excel, how we can calculate the SOCF, that means statement of cash flows in a very easy method, a shortcut method. And of course, there will be a cash flow statement model and notes to those uh, SOCF. So, what is a statement of cash flows? It's a financial statement that shows how cash entered and exited a company during an accounting period. So, in and out of cash during an accounting period. Okay, so cash coming in and out of a business, that is called a cash flow. Flow of cash in and out of cash. Yeah. So that is an important part of the financial statements, which is mandatory requirement during the year end, during the preparation of annual audits and for regulatory authorities, for everyone. Okay, so what is a statement of cash flow? So let us check a model. This is a typical model, okay, statement of cash flows. So I have just written here the main headings, yeah, whatever required to be disclosed during preparation of statement of cash flows. So first thing, under indirect method, we starts from net income. Okay, so and then the adjustments and the changes, yeah, the changes from day one until closing of the year. What were the changes happened in various current assets, current liabilities, and in fixed assets, and in our partners' capital accounts or other financing activities. So that is actually here I am going to, before explaining anything, I will show you a shortcut method, a fast shortcut method, how to prepare a cash flow. So for preparing a cash flow, we need a balance sheet that is with a comparative number. You know comparative number, yeah? All of you know comparative number. If you don't know, comparative number is the past year number. Current year number and past year number is required. Two balance sheets. Two balance sheets are required to prepare the cash flow and definitely income statement of the current year. So here we have two balance sheet. Okay, 2018. This is for current year. So we are preparing the cash flow statement for the year 2018 here now. Okay, so we have the past year number. Okay, this is current year. That is why I written CY, and this is past year. Okay, this is 2017. So we need two last 2 years or current year and past year balance sheet numbers. Okay, required to prepare the statement of cash flow. Okay, and we need an income statement. Okay, so we have the income statement here. Okay, here sales is there, and the direct material cost, and manufacturing indirect and direct is there, and cost of goods sold, which makes us the gross profit, and general and admin expenses, various expenses, yeah, paid during the year, yeah, and the depreciation and amortization, and finally the net income. So just check whether the net income, this 53,345, which whether it is matching with the current year uh, balance sheet or not, so that we can make sure it is the correct number. Yeah, it is $53,345. Okay, now we have 2 years balance sheet. That is one requirement, and the current year income statement. That is the only requirement for preparing the SOCF. Yeah, SOCF, statement of cash flows. Okay. Now, before explaining the theories, let me tell you how to prepare. It's in a within like 10 minutes how we can prepare a statement of cash flow in Excel. Okay. So for that one, I have created a shortcut here. So what I'm going to do, I'm just preparing in the same sheet because this is here. There are two balance sheets are here. So we will go to the model. Okay, I will copy that model to here so that everyone can understand easily. Okay, so I will just paste it here. So we are going to prepare in this column the statement of cash flows because we have the balance sheet here. Okay, now for preparing the statement of cash flows, we need the net income from operations for the current year. Yeah, because we are going to prepare for 2018. Okay, let us check what is the net income for 2018, which you can see in the balance sheet itself. If not, you can just, yeah, this is the one net income for the current year 53,345. So just you need to make sure this 53,345 is the net income. You can check it in the income statement. So here is the income statement which shows 53,345. This is our net income for the year 2018. Yeah. Okay. Now we got the net income, and then we got an adjustment for non-cash items. Yeah. So we need to identify which are the non-cash items in the balance sheet. So read your balance sheet, both numbers carefully. Trade receivable is connected to cash, inventory, guarantees, advances, employees advances, bills receivables, investments, other current assets. So these are all our current assets. Here you can see the long-term assets, fixed assets, and accumulated depreciation. So this accumulated depreciation actually a non-cash item because during the entry, journal entry of depreciation, all of you know, we will debit the depreciation expense and credit the accumulated depreciation. So all the whatever depreciation expenses charged will come here, right? So there is no impact of cash. That is why it is called non-cash item. So that is the first one in the non-cash item. So for recording this, I will use this formula: current year minus previous year. Okay. So current year is 2018. So let us check current year minus previous year balance. So I will take this number 73,915. Yeah. So that means this 73,915 need to be added back. This is a plus amount added back to the net income, right? Because during depreciation write-off, our income has affected. Our income is reduced because of this amount. Okay, so that is why we adding back to the balance because this depreciation is not at all connected to cash. Okay, now let us see any other items are there. This is accumulated depreciation is a non-cash item. Everyone knows fixed asset is a cash item because while purchasing assets, cash is included in there. Okay, trade payable is not a non-cash. Accrued staff cost not non-cash. Other accrued liabilities. So here another one comes end of service benefits. End of service benefits is another non-cash item. So we need to record that. That one also current year minus previous year. So what is the end of service provision here? We have provided. So current year minus previous year. Here is current year end of service 18 minus previous year 17. Yeah. So that will give us 13,141, which is also added back because that is only a provision. Yeah. So now we need to check for the next item. Actually, each and every item in the balance sheet need to be recorded except cash and the retained earnings and the income. Yeah. So in this calculation, we will not take cash, but cash is required. Opening balance and closing balance is required while for confirming the cash balances. Yeah, we will not take the movements in this SOCF calculation here. Actually, we are working on the movements. How this 40,000 became 115,000. That is SOCF. That is what is called statement of changes in statement of cash flows. Okay. Now, our next part, we need to check whether there is any other non-cash items. No other non-cash items are there. So let us move to the next part. So here we got uh, after adjusting the non-cash items, we got 87,056, right? Now we need to check the changes in working capital or changes in cash flow from operating activities. Yeah, what were the changes in operating activities? So first we will start with current assets. Current assets in the balance sheet, you can see the balance sheet. First one is cash and cash equivalent, which we are not taking. We will not take this movement because we are working on cash flow. So we are trying to find out the why, what are the in and out during this period. Okay. So here trade receivable, inventory, these are all current assets. Yeah. All these up to here, these are all current assets. So we need to show the movement here. So during current assets, I have created here previous year minus current year. That is for what we required. Okay. So accounts receivable. Check for accounts receivable, trade receivable, accounts receivable, same. So accounts receivable previous year it was 4,000, 4.3 million. Yeah. Minus 3.8 million for the current year. Yeah. So we got 438,000. Why it is 438 plus? Because there is a decrease. Yeah, there is a decrease in trade receivable. There is a decrease in current asset. Yeah, if there is a decrease in current asset, we need to add back these things. This theory part we will discuss later. So this is just let us calculate the statement of cash flows under this method very fast. Okay. Then next thing, inventory. Inventory, you can see it here. Inventory, that is also PY minus CY, means previous year minus current year. Okay. So inventory previous year minus the current year. Current year means the year which we are, because we I'm preparing for the year 2018 the cash flow. So that is called 2018 is the current year. Okay. Now guarantees and security deposits. You can see the guarantees and security deposit. This is zero, even though we can just make it. Okay. Then advance to suppliers. Yeah. What are the changes to advance to suppliers? Here is the advance to suppliers. So we will apply the formula PY minus CY. Yeah. So why PY minus CY is here, it is coming negative balance because this is increasing. Yeah. In the accounts receivable, it was decreasing. So here it is increasing. Advanced suppliers increased in current year to 255K from 130K. Okay, now let us go back to employees advances here. Yeah, this is employee advances. So we will apply the same formula PY minus CY. And the other current assets, we have the other current assets here. So PY minus CY. Now what is remaining? We have completed here, but what is remaining? This investments, right? Investments is it is not an operating activity. Actually, we are looking the changes in cash flow from operating activities only. Investment is an investing activity, right? From the name itself, we can know it is an investing activity. Okay, so now we have finished uh, entering the movements of current assets for the year. Yeah. Okay, now let us move to current liabilities. Current liabilities, let us say, you can see the current liabilities here. Yeah, in the balance sheets, current liabilities. These are the three accounts. Okay, so we'll mention all the three in the cash flow statement also, which I have already written here. Accounts payable, accrued staff cost, yeah, and other accrued liabilities. Okay, so now for current assets, we have taken like previous year minus current year as a formula. Now here for current liabilities, we will just take the opposite. Current year minus previous year. Okay, so this accounts payable can you can see the trade payable, yeah, current year minus previous year. Same way, we will take accrued staff cost, current year minus previous year, and other accrued liabilities also current year minus previous year. Other accrued liabilities current year this amount and previous year 881. Okay, now we have completed the second part. This is first part is non-cash items which we have under depreciation and end of service gratuity provision. Yeah, amortization of depreciation and the provision for end of service. In the second part, we have calculated the current assets, movement in current assets where we have applied previous year minus current year. Here also we applied current year minus previous year. This is just opposite. So the same way, whatever we have calculated the non-cash items, we calculate the current liability section, current year minus previous year. So we got 210,000 as the net change in cash flow from operating activities, from current assets and current liabilities. Okay. Now let us move to the next part, investing activities. What were the changes happened during the year in investing activities? So here you can see if you check the investing activities section, yeah, this is an investing activity because in current assets we have entered all other items here, excluding cash. Trade receivable we have shown, inventory shown, guarantees shown, advanced supplies shown. Okay, employees change shown, bills receivable there is zero. It's already mentioned. Other current assets also shown. Now only this one. This is investment. So we need to show the investments in investing section. Okay. Now for investing activities, we will use previous year minus current year as the formula. So investing, okay, previous year minus current year. Okay. Now check the fixed assets because we have completed up to all the assets completed. Yeah. Now fixed asset is remaining. Okay. So what were the changes in fixed assets? So fixed asset also we will take previous year minus current year. Yeah. Previous year minus current year. There is no change. There is no movement because we didn't purchase any fixed assets during the year. Okay. So if there is any check, if there is any intangible asset or other long-term assets, so you can check the balance sheet. So we have covered the current assets here, long-term assets covered, fixed assets in under long-term asset, fixed assets already done, and accumulated depreciation we have taken as a non-cash item here. Yeah, and then so we have covered the complete asset side. Now let us move to the liability side. Liability side, this one we have already covered the current liabilities, three parts already covered here. current liabilities. Yeah, we have already taken the moments. Okay. Now there is end of service also covered as a non-cash item here in the first part. Second point, first part, non-cash items. End of service also covered. So make sure you cover everything except cash and retained earnings and income. Yeah, net income. Okay. Now here you need to check the capital whether there is any change, whether there is any new injection. If the shareholders are injected new, so that one also need to come here. So there is no change here. So we will check current year minus previous year for the capital. Current year minus previous year, there is no change. There is 4 million. It's 4 million only. And the partner's account. What is partner's account? Partner's account means whatever cash injection made by the partners are other than capital. Yeah, maybe it is payable or receivable from partners, whatever. So we need to check the partner's account. Partner's account is here. Okay. So we will check current year minus previous year. Current year minus previous year. Okay. So that is we have already taken all the balance sheet items except this retained earnings we will not take because this is connected to income, right? Retained earnings and net income and the cash and cash equivalent balance we will not take. All other items, whatever appearing in the balance sheet, you need to check and identify the movements and enter it here. Okay. So now we got net change in cash flow from financing activities also. So this is the financing activity change, and this is the investing activity change, and this is the operating activity change, and this is after after adding the non-cash item into the net income. Okay, now let us find out what is the net change of all those. Okay, so we will sum all the totals. Net change in financing plus net change in investing plus net change in operating plus this is after removing the non-cash items, net cash flow from operations. Okay, so we got net change 21,743. Now, what was our beginning balance of cash and cash equivalent? This we can know from the balance sheet. The comparative balance sheet means the past year balance sheet, the beginning balance of cash, right? So in 2017, this was end of 2017. Yeah, this was 40,000 was our cash balance. Okay, here in the net cash flow from operations, yeah, we have taken only the movement, so we have to include the net income, whatever we have, our opening statement here, net income. Okay, so this is 140,000. So just let us check now the net changes in cash flow, right? Net changes in cash flow means net change in cash flow from financing, net change in cash flow from investing, net change in cash flow from operating, and after removing the non-cash items, the cash flow from operations. So we'll give you the net change in cash flow 75,088, and the beginning balance you need to take it from here, right? Because at the end of 2017 or the starting of 2018, our cash balance was 40,000. So that is written here 40,014. Okay, and the ending balance will be the sum of these two, right? 75,000 plus 40,000 will give you 115,102. Now just you cross check whether it is matching or not. 115,102, just check. Yeah, it is correct, right? So this is called statement of cash flows. Yeah. So this one, it is matching now. No issues. Nothing to be worried. Yeah. So from the balance sheet itself, we have calculated this total balance. But we need the income statement sometimes, because we need to make sure two, three things from the income statement. Okay, here you can see the income statement: sales, yeah, total sales, direct material cost, whatever cost you have paid for the materials, yeah, used to produce this much number of sales, and direct manufacturing, indirect manufacturing cost we have paid for production, during production, and this cost of sales, this is direct material cost, and the manufacturing cost, yeah, these three makes the cost of goods sold, which is 691. And the difference between 1.2 million, that is total revenue minus cost of goods sold, will give you profit. So in this section, there are no unusual transactions. All are related to usual business operations, right? So there is nothing to worry during preparation of your cash flow statement. Just make sure there are no unusual items here. And in the second part also, you just check these are the general and admin expenses: salaries, end of service, marketing, rent, visa, utilities, travel expense, medical, audit fee, vehicle expense, other miscellaneous expense, transportation, bank charges. Yeah. Also, you make sure there are no unusual transactions. What is called unusual transactions? Because if it is not connected to daily operations, the business operations transaction, that is called unusual. For example, like selling of fixed asset, selling of a computer, that is unusual, because our job is not selling of a computer. Yeah? Instead, we have a product for sales in the operations. So if there is, that is we have already recorded here. So if in the income statement you see selling of a computer, gain or loss of selling of a computer, yeah, wherever in here, mostly you will see in the general admin expense loss of sale on or gain, or maybe you will see under other income, yeah, loss on sale of computer or gain on sale of computer. So that transaction itself we need to show separately. Yeah, how we'll show it as separately? First, we will remove that effect from the operating section. Yeah, we will remove from operating section, and then because it is sale of computer is an investing activity, so we will show it in the investing activity. So that is why I'm telling you, check, just check the income statement. There will not be more, one or two transaction might be there. Yeah, here there are no transaction. Yeah, in general and admin expenses also, these are normal operational daily operations expenses only. And this is depreciation. Yeah, and just check whether our net income is correct in the balance sheet 53,345. Yeah, you can see the same profit in 2018, 53,345. Okay. Now, now let us check how, whether it is this report we have prepared under a shortcut method. Yeah. CY minus PY. What is the CY and current year minus previous year? Yeah. Whenever you prepare a statement of cash flow, you can apply this equation. Yeah, it will work. So let me show you how it works. Okay. So the preparation of statement of cash flows, in my words, I will, if you ask me, I'll tell you, it is just conversion of our net income into the cash. Yeah. Because we need to know how we prepared our net income. There are accruals, there are non-cash items, there are a lot of other expenses entered into the net income. So we are removing whatever not required or whatever not connected to the cash. So we are converting the net income into the cash. Okay. So first step in preparing the cash flow is remove non-cash effects. So that is what we have done here. We have removed the depreciation and the provision. End of service. Removed means during preparation of net income, if we are charging depreciation, means what will happen? Yeah, the net income will decrease, right? Because we are debiting the depreciation account. That is why the net income will decrease. So here we are adding back to remove that depreciation effect. And in the same way, end of service, yeah, we will debit the end of service expense account and credit the provision. Yeah, provision is in the balance sheet under liabilities. So we are also adding that back because this amount also cost to decrease the net income to this much amount. So both of these were removed. Yeah. So our net income became, after removing the non-cash items, 140. Yeah, that is the first step. And the second one, you check your balance sheet. Each and every items in the balance sheet other than cash and retained earnings or net income should be included in the cash flow. So first thing in the balance sheet will be current assets. So I will say any increase in current assets you decrease during the preparation of cash flow statement. Any increase you deduct that amount. So vice versa also you need to think of. I just written one point only. Any decrease will add. Any increase will deduct and any decrease will add. And also the same way current liabilities, any increase you need to add and vice versa. Decrease will deduct. Huh? And any increase in fixed asset, yeah, same like current assets, any increase in fixed asset you deduct and decrease you add. And in the financing, any increase you deduct, yeah, and any decrease you add. So this is a basic concept you need to remember. And the if you remember these four, so you know what to do during the decrease of those items during preparation of SOCF. Okay, now here I have prepared this shortcut because this will help us. There are a lot of addition, deductions, plus, minus. So to avoid that, you just remember this: any non-cash item, like depreciation, end of service, and end of service provision, you just do this one. Yeah, deduct the current year value with the previous year. Yeah, and current assets. Yeah, deduct from previous year value the current year value, and current liabilities. Deduct the current year value from previous year value. And during financing, in the financing activities, deduct the previous year value from current year value. And investing, deduct the current year value from previous year value. Yeah. Whenever you prepare, you ask to prepare this SOCF, the statement of cash flows. There should be two balance sheets, right? So that is what is I have written here. One is current year balance sheet and another one is previous year balance sheet. Okay. So this is the shortcut to do that. So you can apply this formula in all your statement of cash flow preparation. Okay. Now let us check what are the requirements for cash flow and what we need to check before starting our preparation. Okay. There should be two balance sheets. Yeah. One current year and one comparative figure. Comparative figure means the last year. Okay, so that is if there is only with the only one balance sheet, we cannot prepare the statement of cash flows. There should be two balance sheets, current year and previous year. And the income statement. Why you need the income statement? Because we need to make sure the income is correct. Income reported in the balance sheets is correct. And also there are no unusual transactions like sale of fixed assets, issue of shares, yeah, and there are no dividend payments, there are no loan paybacks, yeah, there are no share issuance, yeah, new shares not issued, like that. That is why we need to check the income statement properly for all the transactions other than daily business operations. Yeah, other than daily business operation transactions. So this transaction will come only one or two in a year, but you need to just make sure that if there are any such transaction, then that has to go to concerned groups after removing from operating section. Yeah, first you remove from the operating section, then you show it either in the investing or in the financing section of the uh, SOCF. Okay. Okay. Confirm non-cash transaction balances with P&L. So non-cash transaction means the depreciation, end of service benefits, like we did here. Yeah. Okay. Here the depreciation is 73,915. Just to make sure in the income statement we are showing it. They are showing it as, yeah, depreciation here 73,915 is the depreciation. That is what we have deducted here. I mean added up here. And then end of service, just now we have checked that 13,141 is the end of service. Yeah, you make sure these non-cash items also matches with the income statement. And make sure all heads in balance sheet checked and included. Yeah, all balances in the balance sheet, all the items need to be included except what? Cash, net income, and retained earnings. Yeah, those things, because since we are doing the statement of cash flow, cash movements will not be included anywhere. And net income, that's we are taking in the first line. Yeah, the first line means, yeah, we are converting the net income only from the all the other changes in the balance sheet items. Okay, and retained earnings. Retained earnings is the accumulated loss or profit during previous years that now need to take. Okay, so that is all for the uh, cash flows. So friends, thank you very much for watching the video. Yeah, support me, subscribe the channel, and if you have any comments, if you have any doubts, you can ask me. Okay, I'll be there to help you. Thank you. Thank you very much.